Well, it's not often as traders and investors we witness history, but for the first time ever, the Dow Jones traded above 40,000. Meanwhile, JP Morgan and Goldman Sachs are coming out with some cautious views. But are they actually correct, or are they trying to scare us off? In today's video, we take a look at the big key levels ahead of trillions of dollars of options expiration into this month's OPEX. And more importantly, we look at the availability of some amazing trades and opportunities out there. With Tesla hitting our key level over the last 24 hours, US oil starting to improve, and of course, the big one that we all need to be paying attention to is the financial markets telling us something very different to the stock market. Join us as we cover stocks, commodities, and cryptos moving forward. This will be a good one. Let's get into it. Well, welcome back everyone to The Daily Show. My name's Tom, and as always, you've joined us to discuss the macro, the data, the lead indicators, and the hottest charts and why they're moving the markets right now. If it's your first time here, then remember to subscribe and smash that bell icon, especially if you want to bring simplicity to the overcomplicated when it comes to markets. We do that every single day here, and we talk about it together. So let's jump into the big discussion. Of course, we just saw the Dow do something pretty wild. In fact, from point contribution to the Dow between 30,000 and 40,000, guess which stock actually drove the most gain? You might think it's Microsoft or something else, but actually it's Goldman Sachs. And what this is telling us is that financials are leading the charge at the moment in markets. And is this a bad thing or a good thing? Well, join us as we discuss this topic because, of course, this is possibly the most important sector to be watching over the next couple of years. Now, remember this one, the yield curve inversion ratio. Now, it's been a while since I've ever seen this chart shared, and why is because people have forgotten about it. But what this is telling us is that we have a massive mound over here of over 83.64% of all of the yield curves inverted right now. Now, that's telling us something. The bonds market says something's very wrong, but of course the stock market says something is very right now. And it's important to note that when this curve starts to turn down is when you want to be getting a little bit more cautious. Now, of course, we'll share this over the next 6, 12, and 18 months, as I do expect it'll eventually turn. But for now, really all that's happening is more yield curves are actually getting inverted. This is the biggest we've ever seen in terms of recorded history, and I expect it to unfortunately end up like it always has, in a recession that most of the world will be going into. Now, let's have a look at another thing though from that point of view. The 10-year versus the 3-month, often considered the most important of the inversion yield curves, along with the 2-year. Well, it's been about 564 days at the time of this recording since we first saw the yield inversion curve. And on average, it goes for 589 days. But remember, this time is a little bit different. It's bigger than it was before. So we kind of expect it to be anywhere from 800 even into maybe 1,000 in terms of the amount of days that we stay inverted. And this is going to be very important if you're a bull in markets. We want to remain bullish while we're inverted, and we want to start thinking about being a little bit more bearish when the inversion comes off. So why could this be? Well, it's partly due to the new technologies that are coming around. Now, we all know that every single company wants to mention the word AI, but did you know that the companies that literally have done nothing for 10 years in terms of overall investment just mentioned in their first quarter earnings, this is the energy sector, AI as much as almost communication services and infotech. Yes, they're trying to convince everyone of a glorious turnaround, and I just think it's hilarious. Expect every single one of the different sectors within the S&P 500 to basically be mentioning AI equally to each other, and I would expect all of these guys to start playing catch up, especially things like consumer staples, utilities, etc. It's going to be hilarious, and they're all going to mention AI over the next couple of years. What about the S&P 500 annual buyback? Why are we actually leading into this market with so many rallies? Well, Goldman Sachs forecast here says that buybacks aren't going anywhere. And if you actually look at especially the last decade, a lot of what the market's been doing in terms of moving on the upside has actually been due to these buybacks. And buyback executions are huge right now, and they're not expected to get smaller. In fact, according to Goldman Sachs, they're going to exceed $1 trillion for the first time in 2025. So as long as this exists, as long as we have these extreme buybacks, do you think the bears will be able to take over the market? It kind of seems unlikely, and that's why pullbacks may be met by bull demands. On top of all of this, earnings sentiment has been increasing. In fact, for the Q1 earnings, if we take a look here, you'll notice that the S&P 500, the stocks, the MSCI, all of them have been increasing, but the S&P 500 has been increasing at a faster rate. Effectively, everyone's getting very optimistic on the future, probably due to those AI calls, and it means that there's probably going to be a lot of upgrades from banks, because take a look at this one. Goldman Sachs still have their year-end target for 2024 sitting at 5,200. Expect that to be upgraded, I believe, very soon. And again, that will give headwinds to market managers, investment managers, and everyone else that uses these types of techniques to then tell their clients that they want to invest, etc. I would expect them to go somewhere between 5,400 to even 5,500 by the end of the year. So expect upgrades and forecast upgrades across the board, guys. I think it's coming. Meanwhile, all of this, you would think, okay, well, the market's pretty bullish. They're obviously moving up. We'll look at the charts very soon to see whether the options agree with that. But one thing's for sure, no one is freaking out. Indexed 3-month implied volatility has dropped like a rock. And it doesn't matter what sector you're looking at, they're all super low. It's one of the lowest reads we've ever had. And it basically means we're in a level of complacency. Now, does that mean you go out and you buy a huge amount of puts? Well, I apologize for this blurry screen, but I just want to kind of point out that this earnings season has been positive on the earnings, 60% across the board, and consumer staples has been the best sector, 83% positive surprise from consumer staples. So what are the biggest players doing? Where are the flows going right now? Well, if we have a look at the most recent filings, there are some interesting ones. Now, of course, Druckenmiller, Stanley Druckenmiller, is one of my favorite investors of all time. If you don't know who he is, he averaged over 30% on billions of dollars for like a 20 plus year track record. That is incredibly hard to do. If you're doing it on a few mil, that's much easier, but doing it on billions is very tough. Well, what he did was he bought a bunch of Russell 2000 calls, I believe starting to bet on a broader rally, but also on innovation starting to be one of the big things that comes out of the Russell 2K. New companies that no one really knows about, or they're just starting to find out about them. He is probably starting to bet on this. And you'll notice that he started burning his NVIDIA position down 72% from his previous holding, and he basically has gone in on Russell 2000 calls. So Druckenmiller is starting to, I think, hedge his portfolio a little bit into the idea that he thinks this rally can continue, but at the same time, he's basically saying, you know what, I don't want to have all of my eggs in the AI basket right now, such as NVIDIA, as I think that's extended. And we're going to have to bet on what the US has always been well known for, which is innovative new companies. Meanwhile, Michael Burry, often considered the biggest bear in the markets, he's kind of gone and done something a little bit different. And in many ways is what we've been discussing for quite a while. Now, of course, the filing is from a little period ago, being the 31st of March. So he's already up on some of these positions, but he's been buying the gold stocks. We obviously love gold, and physical gold in particular is what he's been looking at. This is what central bankers have been doing for a while, in particular China and Russia. And he's also been buying up a little bit of Chinese stocks, which we've been looking at, and we'll show you later on today's video if it's your first time here, how good they've actually been over the last 3 months. Now, what about Warren Buffett? Well, his filings are out as well, and it shows that he's added a position in Chubb. Now, what I've noticed is a few of these biggest players are adding positions in prison stocks and security stocks. Now, that could be seen a lot of different ways, but let's just say that if we do go into any kind of instability in the economy, I don't know, we'll see how it ends up playing out, but I bet you it's some kind of a little bit nastier way of looking at things in the future. So Chubb being added to 28.97%. Meanwhile, of course, we see Warren Buffett downgrading his own Apple position and selling a bunch of that, although it is still a massive percentage of portfolio, 40.81%, and Chubb still very, very small across the board. So what do you think about these moves? Let us know which is your favorite from those big players in terms of the overall, Druckenmiller, Buffett, or overall Michael Burry portfolio. Which one do you like the most? Let us know in the comments down below. Let's look at the broader market before we go into the charts. So are things looking good? In general, yes. Percentage of S&P 500 stocks at 20-day new highs, the highest we've seen in 2024 so far, hitting over 40%, very broad. We're also seeing percentage of the past year in terms of New York Stock Exchange and NASDAQ stocks at new highs that were greater than new lows. That's starting to improve. Again, it's a big tick when you think about it from a market perspective and the overall kind of run right now. And small caps are still trading right around their average. So are they expensive? Not really. Are they fairly priced? You would guess yes. So if you think that small caps are the place you want to be, remember 37% of them don't make any money, which is an important fact in 2026 in particular, where they're refinancing. then this is going to be a very interesting chart for all of us out there right now. So what else do we think is really important to be looking at? Well, of course, averages, year-to-date performance, how things are moving with each other. These can all be important factors. And as we've discussed several times, we're following some kind of 1976, 2012 election year kind of concept. And my belief is that there is a possibility of a secondary sideways kind of pullback here with a rally that then leads into maybe September, and then maybe a little bit of a sell-off with some instability into the election, and then of course a rally from that point. That is the most likely scenario if we go overlay everything. The other likely scenario is that we are in a cyclical bull market that probably isn't going to end anytime soon unless there is a massive adverse effect. The W word, or something to do with, of course, the central bankers around the world freaking out and doing massive rate cuts quickly. And of course, the speed at which they rate cut needs to be looked at. If a rate cut comes out, they're cutting 50 basis points or more very quickly, you've got to be concerned. Remember, central bankers do not cut out of the interest of your portfolio. They do it because they're overreacting to pushing the system too far. If we take a look at these cyclical bull markets, though, as we've mentioned several times before, the median duration should be around 32 months. So we expect that really pullbacks again will be met by bull demand generally in this market. Now, if you're a longer term investor and you've got money on the sidelines, do you like the markets right now? Well, history would say not really. Price-wise, things are too expensive. And this is the big problem. You know, if you know about your timings, if you believe there's upside here, which of course we do, then you might say, well, I think I can get in, maybe trim some and then get out and then wait for, better pullback. History would tell you in similar circumstances, with the amount of yield curve inversion we have, with the length of time that we have, and the PE that we have, that the 10-year forward gains at the current price are very bad. And this may be wrong, but in general, it would be something that I think you want to keep in the back of your mind. It's a time to be cautious. And I think what that means is that you want to be buying the right sectors, the right areas, looking for the right growth, but at the same time, maybe not over leveraging or starting, wild businesses where you're taking huge amounts of debts on while we're at some time like a late cycle, which is probably where we're at this point. NASDAQ performance from May 11th to the 31st. Well, we're now at the 17th. As Wayne said here, 100% track record in similar circumstances where we had a decent run into the beginning of May and basically found that, it was pretty bullish. But let's jump into the charts and have a look at a few other things. We'll look at sectors first up here. Couple of defensive sector moves over the last 24 hours coming into the OPEX. In particular, staples really coming out with a 1.42%. Remember, they are actually the best positive surprise earnings in terms of this earnings season. So that's something that's very interesting. I also noticed that home builders got smashed 3% over the last 24 hours. That'll be one that we keep needing to watch. Semiconductors in general, the best over the 5-day. Technology, biotech, bunch of defensives, utilities, one of our favorites at the moment. They're all kind of up the top, and energy is falling behind, although that may be about to change, especially if oil does what we expect it to do over the next coming sessions. So let's now take a look at the S&P 500. And you'll notice I've got a little bit of a stop sign here. And I kind of cautioned the last video that I thought due to the options expiration that we would sit around 5,300. And I kind of still believe that there's a little bit of sideways to downward action around this point. Now, this particular indicator is kind of showing me that we're at an exhaustion phase. And that doesn't mean extreme pullbacks, but it can mean a little bit of red before it goes green again. And if you notice, whenever you get these types of reads, which don't happen that often, by the way, that it can be like, temporary toppings in markets or just a couple of days of weakness. So something to be, certainly paying attention to. Who won out of the bulls and the bears over the last 24 hours? Well, clearly it was the bears. The market pushed up, hit into some levels, got a couple of calls, obviously bought into it, and then we moved on the way down. But you'll notice that we haven't really taken out any significant turnaround levels. So really we're looking for these demands down here to be broken through. And what that means for us as traders and investors, as we look at the futures here, is that we still have a very strong 5,200, 5,180 level. We have not only the daily 20 moving average, which is this red line, but we have structural demand, and we also have anchored VWAP. So basically we have a lot to like about a 5,180 to 5,200 level, and we have a lot to like about seeing a buyer come back in. For For the next 24 hours, the expected move from the market is 53.31 as a possibility to the top end and 52.62 from the bottom end. What these options expected moves are is where the options market expects the market to hold 68% of the time, with a call resistance at 5,300, which we'll look at in a moment, and some kind of temporary put support somewhere around 5,200. So let's actually take a look at the options, and you'll notice they're very green. So 5,300, 5,325, we're clearly in positive gamma once again. We've been mentioning this. And what that means from a GEX standpoint is basically if the markets keep pushing higher, especially if they get through 5,300 on the OPEX, then we have to expect some hedging to need to be occurring, and that can push the market and start to squeeze it a little bit more. Now, because of where we have most of the calls being 5,300, it would actually make sense probably from Wall Street's most, you would say, most exciting point of them making the most amount of money to push the market down a little bit and to get underneath most of these green things. Remember, Wall Street mostly does the writing of options, so therefore it's more profitable to sometimes expire these worthless. But yeah, overall positive gamma, 5,300 is the battle zone, and I would think that maybe a 5,250 is quite possible by the end of Friday, just because we have those exhaustion signs and we also have some profitability to be pushing down into these levels. When it comes to the next couple of weeks, as we know, the next Monday in particular is still incredibly positive gamma written. And you'll notice as well that's kind of like swapping from positive to negative gamma zones will only happen around that period we talked about, which was that 51 kind of 80 to 5,200 level. And in fact, put support, as you notice in both of these, sits right around those zones, 51.95 and 51.70 on the Monday. So a lot of options confluence with, of course, the technical analysis, and that's what we always like to see as traders and investors. S&P 500 Q CTAs, we've talked about how Goldman Sachs was claiming that, of course, CTAs would have to drop their positions or at least stabilize their positions over the next couple of weeks. Well, they came back and they actually bulled it a little bit. So I would say they're neutral at this level because we've got up and down all around. So they're kind of holding it in a holding pattern. You can see the same thing for the NASDAQ. And the surprising one, although it still hasn't caught up, is, of course, the Brent. And I was wrong. We need one more day to find out whether this is actually upticked, as we've always got a little bit of delay on CTAs. So we need the price, which is where it is right now around here. I would guess that CTAs have increased their position, but this one will actually be coming in our weekend video. So stick around for that. So let's get into the charts together, and we'll start off here with the VIX. And of course, the VIX is dropping. Basically, volatility's come out of the market, and we showed that rate of change the other day, which led us to believe that the sell-off was over very, very quickly and that we would basically see a rally in markets. So far, that's been proven correct. And if you want to check that out, it's about a week and a half ago on our videos. Now, if you go over here to high yield junk bonds, we're always looking at the bonds market to see if it's freaking out. I would say it's not. So therefore, the bonds market is feeling okay. As I mentioned, home builders, big sell-off here. Be interesting to see whether that actually holds up in terms of showing further weakness. If home builders start to crack over, that is a bit of a warning sign to the markets, but still a little bit early. So let's take a look at copper. And as you'll notice, $5, very important level. Couple of weak rejections, pretty strong kind of signs of exhaustion. And I would think for copper that it might have a temporary pullback. We're still very bullish on this over the next couple of years. But in general, you can see why it's found some resistance here. It went up, cracked this level, and maybe now it's time to consolidate for a period before hopefully moving higher. Now, what copper expansion does mean for all of us as traders, investors, is that there is an underlying government spend that's going on across the world, and that's leading into a demand for everything from AI to EVs to pretty much any type of infrastructure projects out there in the world. If you actually have a look, there's so many things going on right now that you can see why I guess you would say the economies are expanding to a certain degree. US dollar, well, you guys nailed this. Absolutely, perfect trading, basically. We went to 104, massive tick up. That was beautiful to see that we went down to the 104. We're obviously coming back, which is exactly what we expected to see here. And now we find ourselves coming back into a pretty important zone. A mixture of support becomes resistance, a mixture of different moving averages and different tools that all kind of show complements around. And I'm kind of expecting maybe we get to 104.90 for the US dollar, and then we maybe find some further selling. So USD, really weak. into some strength. This is a relief rally in my opinion. There's not too much trade actually that went through a lot of this, even though it looks like a really aggressive candle. So we're just kind of playing catch up, get rid of that imbalance. And then in this case, probably continue the way down. So the USD, the bounce here, if you got hold of that, nice trading over the last 24 hours. I kind of expect a little bit more uptick on the US before it does end up weakening. Now that's meant that gold's been stopped. So as gold hit the highs, similar to silver, and then it kind of, takes a little bit of a breather. Still very bullish on gold, still like the way that we've gone in terms of price action. And of course, we're looking for silver in particular to outperform gold at the moment with a new high on it, as silver is playing catch up to gold. If you ever want to look at that, check out some of our other videos. Also check out silver to gold ratio. That's a very important one. But here's the most interesting chart right now. It's got to be US oil and Brent. So if we have a look here at US oil, you'll notice that we got that huge wick. We did end up finding some buys over the last 24 hours, which is nice, but we're not quite through 80 a barrel, which just so happens to be a bunch of moving averages and some other techniques that are all sitting here at about 80. So 80 a barrel is going to be very important. And at that point, if we manage to break through here, we're probably going to see energy stocks start to perform better. We're going to see oil starting to perform better in general. And yeah, this is a very important zone. We've talked about the bull zone for oil for quite a few weeks here. It came down, hit it, stabilized around it, which is good. And now we move to, hopefully seeing some further bull action. Another one to keep an eye on is, of course, our analysis on UK oil or Brent. And again, we're looking for about an 84.5 a barrel. Similar looking chart, needs some further strength. Brent's going to actually, sometimes Brent goes before US oil, sometimes it goes behind it. In this case, it looks like US oil is playing the kind of like aggressor. So UK oil a little bit behind what US oil is doing, but we need those breakouts, and that will confirm that buyers are back on board. Speaking of buyers, Tesla actually did pretty well. I know it only looks like it's up 0.5% over the last 24 hours, but it came down to our gap fill level. And there was a few things we liked about this zone, and it nailed it and went straight back up, showing us a wick, which is always good, and showing us some strength. If Tesla's going to find buyers, this is about the right zone for it to do so. What do you think, though, in the comments? Do you agree that Tesla's found those buyers? This is the key zone for it. Of course, it's risky. The stock is not without its own faults, but we saw that huge rally the other day. We pulled back to our possible return point. We may not go as low as 163 now, based on what we've been seeing. Want to have a nice 176 kind of breakout here to the upside. And because Tesla's been beaten down, it could go up while the rest of the market goes down. It is feasibly possible to do that. So 176 for buyers to see momentum. That's going to be an interesting one over the next 24 hours. We also saw Intel as well, having some nice pickups. That's one we've focused on a few times in the live session in our Market Masters Club. If you're ever interested, links in the description down below. And it had a pretty nice session actually, last 24 hours. This is a sector that probably no one's talking about, and it's for good reason. It's been really bad for a long time, and this is the real estate sector fund. So basically XLRE. Now, has this started to show signs of pickup? Well, I would argue it's based. In fact, it actually bottomed off in 2023 into 24. So effectively, it was really weak. And now it's playing catch up. Now, could this sector be the sleeping one? I actually think it's always very susceptible to interest rates, to everything else that's going on around the markets. But it has been showing some signs of volume increasing and, of course, trade in it recently. Now, it's a bit of a difficult one. Where do you want to buy this? What do you want to do with it? But I think we will need to have some focus on XLRE. I'll do some analysis on the weekend. One that might be coming back into the charts. NVIDIA, struggling around 950, makes sense. This is where the OPEX level is for it. So effectively 950 kind of, the holding range there is fine for the stock. And then we'll look at the options in a special for NVIDIA next week, because once this $1 trillion expirations kind of go away, then we can move to maybe being allowed to actually see NVIDIA go to a new all-time high. At this point, it's kind of being stopped by that. GameStop, really suffering from flows. The diamond hands of 2021 don't seem to be here. So as we saw in the last video, we kind of expected it to sit between $30 and $40. And the main reason was because that's the only place the calls were. Well, it got even worse than that as people closed their call positions taking profit or just bailing, and it's pushed it back down to 27.67. like any of these particular squeeze stock positions, everyone's kind of become aware of what they are. And what that means is that it requires everybody to hold their positions. Diamond hands was a reason for that, yeah? And people just don't have that type of commitment. They're just all in it for the profit nowadays. So they're usually short and sharp. In this case, I kind of could see it come down, maybe base around $20, something like that. And then we'll be looking for options upticks. And I expect it to come back several times over the next year, where you'll see GameStop going wild a few times. Did you do well in this? Did you do poorly? You don't want to be left holding it. Just remember, you need those kind of longer extended hour trade times as well, because we saw $80 hit, and you would not have got that if you didn't have extended hours. So it's, a little bit of risk there. I'd actually wait for it to settle at this point. Utilities, still pretty nice sector. Just wanted to kind of show you there's a different sector out there than just the normal technology and semiconductors. Utilities have been doing very nicely for us recently. Another one that's been doing incredibly well has been the Chinese market. And HSI in particular, very, very spectacular here in terms of its moves. A little bit of rejection over the last 24 hours, maybe showing it's a little extended, but 20,000 is still our aim. And this is actually a short squeeze. So there's a lot of positions that were trapped short around here, and they've been squeezed out. So that's why the market has been so aggressive. We've shown that in one of our previous videos. Aussie 200, UK 100, FTSE, Aussie, pretty similar markets. Finance, energy, materials and metals. All of those markets are doing quite well right at this point. So obviously the Aussie market is doing better. But that brings us to our discussion here about financials. So if we have a look here at the financials sector, and what you'll notice is that it's been doing very nicely at an all-time high. It is kind of showing signs of at least temporary exhaustion. Again, when I see these kind of signs here, I usually think pull back sideways, so pull back in time, or a little kind of correction, very small one, before we resume. Now, seeing financials doing so well, what's that telling us? It's telling us that people are borrowing money. That doesn't mean it's a good thing long term, but this is the type of late cycle stuff we usually expect. Financials have been performing incredibly well, especially since October lows last year. In fact, if we look at the XLF market, it looks like a semiconductor almost at 35% increase over that period of time. As long as that remains, we're basically in a bull market. So while these financials are looking so strong, you've got to be following them. And I would highly suggest you be watching KRE and XLF and some of the big banks in particular. So right now, a little bit of exhaustion. Maybe we pull back something like a 41.61 or something. I'm not shorting financials, but I am looking at it from a sign of exhaustion, because as you'll see, exhaustion is starting to appear in many of the sectors. So US 2K, well, it's kind of at those highs, looking really nice. Druckenmiller adding two positions here. This actually looks pretty good on the chart, especially if the weekly manages to hold above 2085. So that'll be an interesting close. And it does point towards the Russell maybe doing better than the other markets actually for a little period here. NASDAQ 100, however, while it's at an all-time high, again, stop sign here, exhaustion, pull back to 18,000, very possible. Why? We've got plenty of moving averages. We have anchored VWAPs. We have other things that are sitting around this zone. So very nice extension. I would kind of think that we're going into, maybe a very slow grind, a little bit sideways, something like this, and then continue on. So for long-term investors, would you be freaked out? I don't think so. When we take a look at RSP, the equal weighted market, it's the same thing. No new high. However, we do also have an overly extended bull run here. So a lot of people are saying it's not extended. Hey, let's not listen to them. Let's just actually have a look at what the charts are telling us. Pretty V-shape, very, very nice recovery. No doubt that it's very strong. And when you're looking at this, it makes sense to maybe pull back to these areas only because we don't have any pullbacks the whole way through except for the start. Now, of course, things can go on. They just kind of ramp. But what, in my experience, whenever I see these types of extensions, we usually get a little bit of a pullback sideways for a couple of days or a small pullback in time. So this is something that we always want to be paying attention to. All right, well, let's have a look at the crypto market now. And you can see Bitcoin is pretty much where you would want it as a bull, but not through the zone yet. So 67K acting as resistance as we expected. Remember, we have a high, we have a low, we have a lower high, and we have a lower low. So on the daily anyway, we actually have a downward trend still. So we need to uptrend this by breaking through 67,000. And that's something that a lot of players will be looking at. Also, if we get this, you could argue that this is an inverse head and shoulders with the left shoulder here, head here, right shoulder here, and then if you took that length, that's actually going to give you a new all-time high. So very important point for Bitcoin coming up. Will it be able to break the 67K? This is certainly one thing I'm watching. I also noticed that the alt market is starting to see, some weakness in it. So what that means is that markets, money's flowing out of these. I think GameStop and other things have got people going, well, I want to go put money somewhere else. So a little bit of money flow out of Ethereum. It's actually weaker than Bitcoin by quite a lot. If Bitcoin goes through, I would expect Ethereum to play catch up. So certainly something that we're also watching here on the crypto charts. If you enjoyed today's video, guys, remember subscribe, smash that bell icon. Not too much extra news for the rest of the week. So really it should just be about the trillions of dollars of options expiration. And if you want to follow us over on X, I highly suggest you do. We share a lot of these charts that we have in the videos and other things. All right, everyone, have a great weekend. Have a great Friday, and we'll see you with a special coming up very soon. Bye for now.